Inflation is beginning to ease in some sectors of the US economy, but the Federal Reserve says we still have a long road ahead of us. To shine some light on what we can expect during this so called disinflationary period, we're joined by JPMorgan Private Bank's senior markets economist, Stephanie Roth. Stephanie, thanks so much for joining us.
Thank you for having me.
So, just breaking down the economy then, sector by sector, where are we seeing some relief at the moment, and where is inflation still running high?
So, inflation overall is still running high. It's running at about 4 to 5%, which is well above the Fed's 2% mandate. Now, there are three pillars of inflation that are worth paying attention to. The first is goods inflation. That has certainly come down. We're starting to see disinflationary trends there as supply chains normalize. The second is rent inflation. That has started to come down, at least if you're looking at market based rents. The CPI is a very lagged measure of rent inflation. That's still running high, but it should come down over the next year. The third piece of inflation is the most important one. That's services outside of rent inflation. It's tied to the labor market and it still remains too high. This is what the Fed is most focused on and what they're most worried about. They need to see this come down, and that will probably only happen as the economy slows back down.
And speaking of the labour market, we've seen a lot of headlines about layoffs, haven't we? But the actual unemployment rate remains pretty low. What's going on there?
So the layoffs have been very mild at the margin. It's been concentrated within tech and finance. It hasn't really permeated to the rest of the economy. Eventually, we think that will probably happen, especially as the economy slows down and higher interest rates really take an effect on the broad economy. We do think the unemployment rate will ultimately rise. But right now, the layoffs have been really concentrated in just a couple of sectors.
And looking at consumers like you and I, when can we begin to see some relief from inflation, do you think?
It's important to keep in mind that when we're talking about inflation slowing, it's the growth rates that are likely to slow. It's not prices actually coming down. So, outside of a couple sectors like used cars and food prices, we don't really think that prices will come down for the consumer. The consumers will just likely see the growth rates moderate a bit. So, consumers should at least keep that in mind that the price rates should slow down, but the prices aren't actually likely to fall substantially.
As we mentioned, the Fed is saying that there's a long road ahead this year. So, are we expecting to see more rate hikes?
We should expect to see another rate hike in March and potentially May. And at that point, they'll assess whether those trends are looking a little bit better, specifically if inflation is coming back down closer to their 2% mandate, and if the labor market shows signs of slowing. If the unemployment rate is starting to rise, at that point, they'll stop doing hikes. But for now, we should expect at least a couple more 25 basis point hikes from the Fed.
Certainly something I know you'll be keeping a close eye on. Stephanie Roth, JP Morgan Private Bank Senior Markets Economist. Thanks so much for joining us.
Thank you for having me.